China's property market, a titan that powered decades of growth and lifted millions, now shows alarming cracks. But what if these tremors don't stop at its borders, igniting a global financial firestorm? And let's find the answer to the question, what if? The profound crisis in China's property sector would unleash devastating global financial shockwaves, initiating a massive deleveraging event. Major international banks, investment funds, and pension funds holding significant bonds and loans from Chinese developers would face unprecedented write-downs and severe liquidity crises. This widespread exposure means global financial institutions are intrinsically vulnerable. The initial defaults would trigger a loss of confidence, leading to a freeze in interbank lending worldwide. Consequently, smaller, less diversified banks, particularly those connected to emerging markets, would face collapse, causing a severe credit crunch that chokes off access to funds for businesses and consumers globally. Simultaneously, investors would flee perceived risks, pulling capital en masse from emerging and even some developed economies towards safe havens. This rapid outflow would destabilize currencies, leading to widespread devaluations and further exacerbating global economic instability. The end of China's immense construction boom means a world without builders for global commodity markets. As China, the world's largest consumer of industrial raw materials like steel and copper, drastically cuts demand, global prices plummet, creating a massive supply glut. This devastation immediately hits nations heavily reliant on exporting these commodities, such as Australia, Brazil, and many African countries. Their national incomes shrink, currencies weaken, and governments are forced to cut vital social programs, potentially sparking widespread unrest. This dramatic fall in commodity prices, coupled with reduced global demand from broader economic contraction, unleashes powerful global deflationary pressures. Businesses struggle significantly with falling prices, impacting profitability and leading to widespread layoffs, intensifying a global economic downturn. Next, global trade routes would grind to a halt as financial uncertainty, job losses, and credit restrictions bite. Consumer spending power shrinks worldwide. This directly slashes demand for manufactured goods from major exporting nations. With fewer orders, Chinese factories slow or cease production, fracturing global supply chains optimized for efficiency. Companies would scramble to localize production or find new, often costlier, sourcing alternatives. Furthermore, as national economies falter, a surge in economic nationalism would emerge. Governments would prioritize domestic industries, implementing tariffs and protectionist policies, leading to a further fragmentation of global trade and a significant retreat from globalization. The world's arteries of commerce would constrict, making every transaction harder and more expensive. This global crisis initiates a new era of severe economic austerity, starkly revealing the painful price of interconnectedness. Industries worldwide, including finance, construction, manufacturing, and logistics, face immense devastation. This triggers widespread job losses and soaring unemployment, while wages for those still employed stagnate or decline sharply. Governments attempt bailouts and stimulus packages, but with shrinking tax revenues, these efforts frequently lead to sovereign debt crises, particularly for already indebted nations. This pervasive economic hardship, coupled with perceived governmental failures, ignites profound social unrest and protests. Such public discontent rapidly escalates into political instability, potentially destabilizing entire systems and altering leadership globally. This profound global crisis would fundamentally reshape the economic order, ushering in a distinctly multipolar future. It would accelerate a deep shift away from interconnected global markets, as trust in vast international systems and agreements erodes. Nations seeking stability and security would pivot towards stronger regional blocs. The emphasis would be on internal trade and striving for greater self-sufficiency in crucial goods and resources, insulating themselves from future shocks. This dramatic reorientation would lead to a redefinition of economic influence. New, more resilient economic powers or coalitions would inevitably emerge, fundamentally altering the existing global hierarchy and distributing power across a more diverse landscape. China's real estate crisis would trigger global financial shocks, commodity collapse, and trade disruption, leading to widespread austerity and reshaping the world order. In your opinion, what happens if China's real estate crisis spreads globally? Share your thoughts in the comments.